Welcome back. Now we'll look at where markets ended the week after President Trump announced a new round of tariffs coming on pharmaceuticals, heavy trucks, and furniture. We also saw a surprise jump in second quarter economic growth to the highest level in nearly 2 years. And the Federal Reserve's preferred measure of inflation held steady, the PCE index, in line with expectations, as consumer spending and income increased higher than expected. Joining me now is SlateStone Wealth Chief Market Strategist Kenny Polcari. Kenny, great to see you.
Great to see you.
What did you think of the string of economic data points this week and ahead of next week, even bigger?
It's been a very interesting week, a week that shows that the economic data points remain strong and the economy remains strong while inflation is held in check. Certainly at a little bit of a higher level, but held in check with the expectations. So I actually think that sets itself up for a conversation about maybe we should just leave rates where they are. And these people that are expecting 2 more or 3 more rate cuts need to rethink that.
So what do you think it is then? I mean, the Fed is walking this balance of, telling us that inflation is coming because of tariffs, and yet it's non-existent so far, and we're expecting another rate cut. But I think Jay Powell is trying to measure it out to not make us expect too many rate cuts to come. What are you expecting?
I think you're 100% right. I think he's trying to just take it back in a little bit, right? Take the narrative off this very aggressive 2, 3 more rate cuts and take it in time. And in fact, you've heard a number of Fed officials after the event now come out all saying everybody better slow down. We're not necessarily sure yet. It may not be a reason to cut as aggressively. So I'm actually thinking we get 1 more cut this year. I know the market's expecting 2 and then another one in January. I think we're going to get 1 more cut this year. At some point, good news can be bad news, right? In the sense that the economy remains too strong. There's absolutely no reason to stimulate it further by cutting rates.
So what are you expecting in the upcoming weeks and going into year-end, Kenny? Do you want to own stocks going into year-end? Do you want to buy more going into year-end? And where will the leadership be? Still tech?
Okay, so I absolutely want to own stocks going to year-end. As a long-term wealth manager, we're not in the market to time it while we're getting in, we're getting out. That's not the case at all. We're always invested. So, yes, we're into the market. I fully expect, and we started to see it, but it's the very end of the quarter. So I don't think we're going to see a pullback in the market now till October after the quarter-end marking period. But I think that it'll be the start of earnings season. People will have a chance to digest. It'll be the start of a new quarter. I suspect that the market will try to back off. At that point, I'd continue to be a buyer because I do think we're going to rally into the end of the year right about where we are, 6,700-ish, 66, 67, somewhere in there. I'm not in the camp that we're going to 7,000 by the end of the year, but I am in the camp that we're going to pull back and then end up right about here. And that wouldn't necessarily be a bad thing. It would give investors an opportunity to buy stocks on weakness, on a pullback in October, should we see it. And I'm going to look to sectors that have been underperforming in the market. Tech, of course, you always like tech, but I'm not going to chase it. It represents nearly a little bit more than a third of the S&P. We're already in it. We already own it. There's no reason to chase it up here. So I want to look at sectors like energy or farm or healthcare, right? They're underperforming this year in terms of the broader market. Even consumer staples, which are kind of typically boring, but if your market pulls back, they won't get hit as hard.
What did you make of a 100% tariff on pharmaceutical products from companies not building manufacturing plants in the U.S., 50% tariff on kitchen cabinets and bathroom vanities, 30% tariff on upholstered furniture, 25% tariff on heavy trucks?
Listen, it's going to make the stuff about kitchen cabinets and upholstered furniture is certainly going to make, home stuff, home building, home decor much more expensive, unless, of course, they bring that manufacturing back to the States, which is kind of what he wants to do, right? Yeah. Pharmaceuticals, look, I don't know why we outsourced our pharmaceuticals to foreign countries in the first place. That's a whole other conversation.
Because it's cheaper.
I'd love to have them. I hear you, but then you're dependent on those foreign countries, right? Which is why we need to have them come back here. So I fully support, bringing especially healthcare and pharmaceutical manufacturing back to the States. And if that's what it takes, then that's what it's going to take.
Yeah, and by the way, we should point out that roughly 9 out of 10 prescriptions in the United States are filled with generic drugs.
Right.
So and those are exempt from tariffs. Right. So it's not as bad as, some people try to make it out to be. There are also carve-outs from the UK and the EU reciprocal agreements. So the president is doing just what you said. He's trying to get the supply chains back to America. That's the point.
Right. But the headline, to your point, they're going to see the headline that says 100% tariffs on pharmaceuticals, and they're all, they're losing their minds and they're lighting their hair on fire.
Exactly. Kenny, great to catch up. Thanks so much.
Always a pleasure. Thank you.